Welcome to On My Way to Wealth, the podcast where busy Gen Xers can learn financial tips as they navigate life on their way to wealth. And now, please join your host, Luis Rosa.
This episode is brought to you by Latin Excellence. Visit latinexcellence.com. That's Latinx, CELLENCE.com or latinxmovement.com to learn more and shop our merchandise. You are excellence. Hello and welcome to another episode of On My Way to Wealth. My name is Luis and I'm your host. Today we're going to talk about the bear market. The S&P 500 officially entered bear market territory on June 13th, 2022. Now, before I get into the four things you need to know about bear markets, let me define it first. What is considered a bear market? By definition, a bear market is when the stock market drops by 20% or more from a recent high. So the S&P 500 on June 13th actually entered that territory where it's down over 22% from a recent high. So what does that mean, right? It means it can continue to go down. Absolutely. I'm going to give you some stats to give you kind of like a historical perspective on the average length and things like that to help you make an informed decision. So let's get right into it. First thing you need to know about bear markets is that they are cyclical. So if you are a long-term investor, they're just going to happen. They're part of the normal course of the stock market cycle. So to give you an example, there's been 26 bear markets since 1900, right? So they're bound to happen. So it's something you need to understand. And let me give you some point of reference. Obviously, history doesn't necessarily mean that things will repeat themselves, but it's good to use it just to have a general context, right? So 26 bear markets in 1900, not all of them were necessarily followed by a recession. A recession is typically when we have two negative quarters of gross domestic product, just basically economic output, and usually unemployment tends to be higher at the same time. But it does not necessarily mean that every single bear market is followed by a recession, because the stock market and the economy are two separate animals. Sometimes, there might be some similarities there, but not necessarily the case. Just to give you an example, during the pandemic, the stock market went down about 34%, the S&P 500, right? It lasted 33 days, and the stock market did pretty well after that, even though there were about 22 million people on unemployment, right? And the economy was practically shut down. People were not able to go out. A lot of people were working from home and so on. But just to give you an idea, right? So it is possible for the stock market to be doing well while the economy is not doing so well, and vice versa, which I know sometimes it'd be like, doesn't make sense, but those are the facts. So another thing too is that the average occurrence is about 3.6 years between bear markets. And again, this is just average. The most recent one was February 2020 to March 2020 during the pandemic, dropped about 34%. But before that, the last bear market was between October 2007 and November 2008, where stocks dropped about 52%. And that one lasted 408 days. So we were long overdue for a bear market after that, 2008, right? Now, another thing to keep in mind is that in addition to happening about 3.6 years on average, the average length is only about 289 days of this bear market. One thing you might be able to see in recent history, the ones that happened recently have actually lasted less, like the one in the pandemic, only 33 days, right? Which is not bad at all. So hopefully the one we're in now doesn't last as long either. So what do you need to know? Now, here's the thing. Also, the average bear market is historically has been followed by a bull market, which is the opposite, right? Where stocks just rally and do great. And guess what? The average bull market lasts 991 days compared to the average bull market that lasts 289 days. So if you get out at the wrong time, which brings me to my next point, is do not panic. If you are invested for the long term, if you're using this money, let's say, for example, retirement, you're still several years out, Don't panic and sell now, because you actually be doing the opposite of what you're trying to do. If you panic now, sell all your positions after they've already gone down, you be converting those into cash, realizing a loss. A lot of people tend to do this, and then they wait until the market goes back up and then jump back in and go from cash to stocks again. But what they're doing is selling low and then buying high. That's a recipe for disaster. You don't want to be trying to time the market in that way. So you want to make sure you don't panic, because if you understand that this is cyclical, that historically bear markets are followed by a longer bull market, it might give you some ease. So I wanted to give you that context. So what you want to do is the opposite, right? You want to buy low and then sell high. You don't want to sell low and buy high, right? So do not panic. That's rule number one, which is why it's so important to be working with a financial planner that knows your situation, because they can help you avoid making decisions out of fear and emotion, right? The second thing is you want to make sure that your investments are diversified. And you hear me saying this all the time. The reason for this is because you don't want all of your eggs in one basket, right? So if you have all your money in the S&P 500 and the S&P 500 drops 20%, then you're going to feel the entire weight of that fall by 20%, right? Or 30%, 34%, like in the pandemic. But if you're diversified, you're not going to see as high of a return as you would if you had all your money in one basket, but you're also not going to feel the pain as much when things are down. So you want to make sure that you have a diversified portfolio so that you have investments in different sectors of the economy, different types of things like stocks, bonds, real estate, so that you're not all in one thing. The other thing that helps with that too is that you don't want a concentration or too high of a concentration in just one thing, because you can really expose yourself to a lot of risk. It can pay off, but it can also have a negative effect on your overall financials. So you want to make sure that you are diversified. You don't have all your eggs in one basket. It's a key principle of investing. You don't want everything going up at the same time, and you don't want everything going down at the same time. If your portfolio is acting that way, then it's probably not properly diversified as well. So keep that in mind. And the other thing is dollar cost averaging. You might have heard me say this as well in the past. What this means is that you buy a certain amount every single on a regular interval. So let's say monthly, for example. Some people put money like, okay, every 28th of the month, I'm going to invest X amount of money per month into my investments. Or for example, if you're putting money into your 401k, you are by default already dollar cost averaging, because every paycheck, a portion of your paycheck is being invested. And what's cool about this is that you're doing this with zero emotion. It's happening regardless of prices, whether the market is up or the market is down. And what's helpful about that is that you're not trying to time the market. You're just consistently putting money in on a specific date, regardless of what prices are doing. Because the last thing you want to do is try and time the market. Nobody has that crystal ball, even the most experienced investors. So you want time in the market. You don't want to try to time the market, because that is a recipe for disaster. One of the recent episodes I made was talking about the difference in your rate of return if you miss just like the top 5 days or 10 days in the market, right? So you want to make sure that you are in position to take advantage of that rebound when the market eventually comes. It doesn't mean that every single investment you have will come back up, but historically, the broad indices in the stock market as a whole tends to rise right after bear market. So you want to make sure that you don't panic, you don't get out of the market unnecessarily, just simply out of fear. Obviously, if you have short-term goals, that money shouldn't really be invested. You want to put that in a place where it's liquid, easily accessible, even if you're not getting the greatest rate of return, right? Just short-term money, like money for a down payment, your emergency saving, things like that. But long-term money that you have, say for retirement, that you're not trying to touch right now for years and years to come, don't panic. In fact, you might even see this as an opportunity if you have the ability to continue to add to your investments on a regular basis by doing something like dollar cost averaging, because ultimately, by doing that, you're also getting a cheaper price than you would if you just bought all of it at once, right? You're spreading out the cost throughout the year. And sometimes you buy higher than other times, but on average, you can lower your cost. So it's another great tool. These are very sound principles that you might hear a lot of investors talk about. So understand that these bear markets are cyclical. Understand that you should not panic because of that, because they are followed typically by a bull market afterwards. They don't tend to last that long, especially in recent history, the one in the pandemic being only 33 days. They come about on average every 3.6 years. You want to be diversified, so you have a wide range of things in your portfolio and you don't have all your eggs in one basket. And you want to make sure that your dollar cost averaging if you are continuing to add to your investments at this time, just so that you are not doing any decisions out of trying to timing or anything like that. So this was a brief one, but I wanted to just get out this information because, a lot of people are asking me questions about it. Some people are panicking. Hey, I lost X percentage. What should I do? And so on. So I want to make sure that that's you. If you're sitting right now and thinking like, oh my God, I saw my 401k statement or I saw my brokerage account statement and it's down so much. Just think about all these things, because if you're in it for the long term, your best move might be to not do anything and sell. It might just mean even to just continue to add to it. So I hope you find this information useful. If you have any questions, as always, send me an email, luis@onmywaytowealth.com, and I'll see you in the next episode. Thank you for listening to On My Way to Wealth. If you have any questions, please send me an email at luis@onmywaytowealth.com. The information provided here is for information and education purposes only. The opinions expressed herein are solely those of myself, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by my firm or myself about other parties' information or accuracy or completeness. All information or ideas provided should be discussed in detail with a financial advisor, accountant, or legal counsel prior to implementation. Thank you.